moderating the session, the panel discussion. So before that, as an intro, to start the webinar going, as a kind of a, what do you call, as a kind of a start, we are going to make a small presentation, and I would request Shama Shri to make the presentation. Thank you for. Yeah.
Thank you, sir. So, I hope people can see the presentation on the screen.
Yes.
Yeah. Yeah. So, we want to present the field observation we have in last few months, rather few quarters. So here I am showing a credit information report of a certain MF microfinance borrower from and you can see that there is different income is reported for a single microfinance borrower. If you see that it has started from 12,000, which is just before the regulation came in place in January, then for a certain date on 30th of June, there is report of two different income for the same household. One is 35,000, one is 15,000. Similarly, in 30th September, it has been reported as 42,700. And in another 2 months, 30th of November, it has been reported at 24,000. Even after that also, there is one lender which has reported as 18,000. Someone has reported as 17,000. So you can see there is differences in reporting of income of a single borrower by different lenders. And this is not a single case. We have seen in many cases that different lenders, different type of lenders also have reported the household of a same client differently, which shows that there is differences in assessment in the field. If you see, this is another observation from us is that we, as you know, Sa-Dhan is collecting quarterly data from you. These are self-reported data where we collect the household income and indebtedness information as percentage of loan disbursed during a quarter. So these are three different MFIs, which are fairly large. I would say the portfolio is above 1,000. If you see the skewness of the disbursement is towards the high income, which is 2.5 lakhs to 3 lakhs. It shows that MFIs are, most of the borrowers of MFIs have an income bracket between 2.5 to 3 lakhs. Another observation is that from the credit bureau information, what we get is that the percentage of borrowers having outstanding above 1.25 lakhs is increasing gradually, though the increase is not very significant in percentage wise. But if you look at the absolute number, this could be a huge number because there are 7 crore microfinance borrowers, unique borrowers at the field. Similarly, there are few subjective observation which we have seen in the field is that the number of loans per borrower or the number of lenders per borrower have increased, and this can be from 2 to 3. It could be now up to 6 or 7. And there is also rejection rates at the time of loan sourcing. When you are sourcing a new client, it has also increased after the new regulations, which is majorly due to high repayment obligation of a borrower's household. So that MFIs are not being able to go beyond this 50%. So they have a high repayment obligation also. Another observation is that this low income household is being targeted by different lenders, different lenders in terms of different type of lenders. Some could be fintech, some could be pure NBFCs who are giving consumptions loans, consumer durable loans. So these lenders are also targeting. So that is also one point that could be increasing the indebtedness of the borrower's household.
And many times it's not getting captured also.
Yeah, many times it may not be captured properly. Also, over last few quarters, there have been report of distress of customers, and which is also came up in the local media. And most of the cases they have alleged MFIs having microfinance lenders that they are giving multiple loans to a single household, though we understand that the concept of microfinance may not be clear to everyone, every local media person. They might have been confusing microfinance with other kind of lending, which could be nidhi companies, which could be micro like non-registered organization working as a microfinance, posing as microfinance, or there could be another kind of small lendings also. But these are few observations we have in the field, which indicates that the current regime or current regulation, income assessment has become a very crucial and critical aspect of the loan sourcing, which can give you, which can affect your credit portfolio quality in the future also. So this is some observation from our side.
Just to reiterate that second key point, which is made in that observation, that if rejection rates are going up, definitely the rejection rates are going up because of the new norm putting a stipulation that not more than 50% repayment obligation should be there. And if the numbers are going up, which shows that we are targeting the same clientele again and again. There is no, I would say, spread of, or expansion of geographical area is not happening. If that happens, I'm sure that second point can be addressed to a great extent. So these are some of the observations just to set the ball rolling. And I think we will be hearing more from our experts, commentators. We have moderator Puri Bowser, and we have the three panelists, isn't it? Yes. So we would be, so we'll head over to Puri.
No, we'll introduce the panelists and
okay.
then over to Purvi.
Yeah.
So we are thankful to Ms. Purvi that she has agreed to moderate this session. So Mr. Purvi is, sorry, Ms. Purvi is from Pahel Microfinance, Pahel Financial Services. She is the one of the founder of Pahel and managing director. I would ask Ms. Purvi to switch on her. Yeah, she has already switched on her video. So our next speaker is Mr. Divajati Patnaik. He is one of the director of Annapurna Finance. So, sir, sir is here. And also from Annapurna Finance, Mr. Anup has joined us. He is the Chief Risk Officer in Annapurna. From Avanti Finance, Mr. Nagaraj Subramanya has joined, who is the Chief Risk Officer of Avanti Finance. And we have Mr. Krishna Chandran, who is Secretary of Kasafi.
So we have quite a learned and eminent panel with us, Purvi being the moderator, and Divajati Patnaik is there, then Krishna Chandra is there, Nagaraj is there, and also who else? Pankaj. No. Yeah, Purvi, over to you. Now it's all for the floor is on for you.
Hello, good afternoon. Good afternoon to everybody. And Thank you, Gigi sir and entire team of Sa-Dhan for this opportunity to moderate this session. This is such a critical topic, and every time, either I am answering questions related to this subject or I am seeking answers, from some of the experts in the industry. Today, I am in a very unique position where I am facilitating the transfer of knowledge. So, really happy to be here and looking forward to listening to from the speakers. Just to set the context right, I was meeting up with a few potential funders yesterday, and they asked me what are your three challenges. And the first thing that came to my mind was over indebtedness. And over indebtedness, to my understanding, is not it's just an outcome, and it is an outcome because it is our inability to assess the correct income or near to correct income of our borrowers, and hence impacting our capacity to come up with the correct FYR. And that's what I saw when this presentation was being made, that somebody said the income is 15,000 and somebody saying 35,000. And this is the main challenge, where you are not able to ascertain the correct repayment capacity of the customer. So this is a big challenge, particularly given the spread that we have, like, more than 1 lakh filled employees, more than 20,000 branches. How do you train so many people, and how do you come up with some more acceptable mechanism of assessing the income? So with that, that is a background. I'll go with my first question for Annapurna. And I would be happy to hear from Mr. Patnaik or Anu. How do you think MFIs can accurately assess the household income when income cannot be verified by the document? So, we have sort of no PAN card and no bank statements and no other documents that is available for us to verify. How do you think MFIs can do that? And more importantly, it would be interesting to understand how Annapurna is assessing the household income. So over to you, Mr. Patnaik.
Yeah, thank you, Purvi, and thank you, Gigi Saab, and all the members of Sa-Dhan, all the people who have joined this conversation. This is really a very close to my heart kind of a subject, and that's why I'm here. The reason being, we were been doing underwriting of individual small ticket size loan when people were even laughing at us when it was not required to do so. From the day we started, we have a dedicated vertical for underwriting. Our branch staff do not do the underwriting. They do not have that skill set to do the underwriting. We have a very specialized branch credit officers. Each branch has a credit officer. His job is only to do the whole underwriting. And one of the underwriting majority of the job that as an underwriter is to ascertain the income and the other indebtedness. So we at Annapurna have a very robust system developed over a period of time, wherein these people are extremely trained, well trained, and continuously getting trained in terms of how do they do the assessment of a cash flow when there is no physical document or documentary evidence available, as you correctly mentioned. There's no PAN card, there's no bank account transactions for a lot of these units. So basically, we have heavily dependent the cash flow underwriting model is heavily dependent on different surrogates. Surrogates by the mean that we take different references in order to ascertain the accuracy of the calculation. For example, their expenses. If I do not have an income proofs, I would have expenditure proofs. So if you can prove me that you have a house, you give a rent, you give a electricity bill, those are anyway paid, and there would be receipts available to do so. That could be a way to look at it. Your expenditures. If I don't have a evidence to income, I'll take the evidence of the expenditures and then decide how much money would be earned because you're spending this much of money. So that's one way to look at it. The second one that we have created is to create. We have created different grids. We call it according, on different businesses. So if a particular person is engaged in, say, carpentry in a particular area, what
Can
should be his ideal cash flow? How
you
much
just
he
mic
should
for
get? Or agriculture or dairy or any, if he has 2 cows, how much he should get? If he has 2 acres of land, how much production that, there's a very, basic information which is available. It's not a very, big brainer out there. So you get those informations, get it there in your system so that whenever they punch any deviation to that kind of a, very big deviation to that kind of a, income that they're supposed to get as a activity, then, you go deeper and try and check, how much is, truth in that. So that is the second way to look at it, like what activity they are in, what kind of land they are possessing, or what kind of a, if it is a business location, how much, how big is that, how many people are employed. So based on that, how much income they should be getting, how much, footfall they should be having. The third is obviously to go and sit and, observe, to get it as a more accuracy point of view, to observe how much they are doing. Some evidence in terms of if they are selling paddy, if they have a paddy procurement quota license with them. Suppose, because nowadays every farmer has a license, how much they can sell to the government, to the public, this thing. So that, if you get that as an evidence to proof that this is this much paddy I am selling, and this should be my income. If not fully 100%, but you get to, to the nearest of that, 70, 80, 90% of the accuracy, of course. And then based on that, and then expenditure. So based on these two parameters, you can always determine what kind of a cash flow these people will have and what kind of a indebtedness. Obviously, indebtedness data is available now from the credit bureau, and now the credit bureau is opened up to the entire universe. You get even all the information around, whether it is a vehicle loan, whether it is a personal loan or consumer durable loan, you get all that. So date point of view, there is no problem. I think enough data is coming. Not only now in microfinance industry, other industries are also looking at submitting the data daily. So that accuracy is also going up like anything. So that is there. So now the only problem that we face is, the income. So what happens is sometimes there are two things also happening. One, sometimes they intentionally hide their income, because if you really calculate their income, they might surpass that 3 lakh benchmark that, you have the RBI has decided, and they know it. So they try to, try to bring down their income by not exposing their other incomes to you. And sometimes they also exaggerate that to get a larger, ticket size of loan. So these both the things happen, and as a underwriter, they have to play a critical role to have that. And as now we are more dependent on technology. These were pretty expensive, and you have to keep training your people to do that with an attrition kind of thing. 25-27% attrition. You are always training a lot of people to do this, and they also get it right over a period of time. So because when we were doing it on a manual kind of a thing, but now with technological intervention available, you can mark, you can layer data on different geographies, what kind of business they are doing, what kind of cash flow ideally it should have, and what kind of a cash flow is they are throwing out. So those things are now getting filtered out very easily. You don't need physically somebody to underwrite now. If you can create that database over a period of time, over a period of time, you probably we can move out of that and ascertain the income and expenditure and indebtedness pretty closer to the may not be 100% foolproof until you get that there and get the digital footprints or financial footprints till that point of time, but I think this could help largely cover the income assessment to the closest to the truth.
Thank you, Mr. Patnaik. That was quite helpful. I understand the challenge that we as microfinance industry face in terms of training so many people at scale, particularly when the attrition is high, and the quality of people that we recruit is also a little difficult in terms of training them more with the technology. So when we're talking about technology, my next question would be to Mr. Nagraj, because Avanti is a tech-savvy lender, and I just want to understand from you as how technology can be used to do a better income assessment, and how Avanti in particular is using this technology to solve the problem that all of us are facing.
Sure. Thanks, Puri. Thanks for Sa-Dhan for this panel discussion. So I think very similar to what Mr. Patnaik said, right? I think with Avanti, the model was we don't have our own individual branches. So we actually work through other local smaller MFIs. We work through other NGOs and other people on the ground who actually do the sourcing for us and kind of manage the life cycle of the loan. And so for us, the challenge is a little bit more exaggerated because each of these different MFIs and the partners on the ground could have very different processes and different things that they are doing on the ground, which makes it's not one standard set of training that we can provide to everybody. So the way we kind of approached and solved this problem was more to kind of say, and very similar to what Mr. Patnaik said, is make the people on the ground, the field officers on the ground, be actual data collectors. But then you create a standard, consistent methodology where the inputs can also be validated in an easy manner. And the calculations are all done on the platform automatically through the inputs that come, right? And that way we kind of take away the inconsistencies across different partners, different people on the ground in terms of how they are calculating different things. It's a common set of inputs that are taken, and the calculation is done in a very consistent methodology that doesn't really differ by which partner is doing what kind of input, right? So what we typically follow is an approach which is where we kind of try and get to understand the assets and the amenities that the borrower has in terms of when Patnaik also mentioned what kind of land do they have? Do they have a two-wheeler? Do they have a TV? Do they own a tractor? What kind of acreage of land do they have? So things like that is much more validatable. So we can do a field visit on a sample basis. We can do calling on a sample basis to validate some of these inputs. And using these inputs, you have an algorithm which basically says this is sort of what the household income could be. Because a lot of the assets and amenities that a borrower is likely to have from a household standpoint is stuff that comes from disposable income that they already have. They're able to kind of buy some of these assets and amenities through that. Things like land, and depending on the area that they're part of, we sort of have a good understanding of, okay, if this person has land in Bihar versus Tamil Nadu, this is the sort of crops that is grown. So this is potentially the output and income that can come from it. All those inputs are basically input into our platform to kind of derive the income. And again, the challenge here is on the ground, field officers are smart. They know that if you increase some input, you will get higher income. So naturally, people want to try and increase the income. So that's where the platform also starts flagging these deviations. It knows that when we have kind of built the insights around, oh, what is the median livestock that a person owns in this district of Bihar versus district in Tamil Nadu versus somewhere in Karnataka. And if it is way beyond the median, then the system flags it for us for a further manual review. But that way, you're not biasing your income estimation by actually taking whatever the input is coming from the field, but putting in some restrictions, some criteria, some justification to say, does this make sense, which is validated, which comes through our own insights from talking to the partners on the ground, doing field visits and doing other validations. So that consistent review over time has helped us get to a place where we feel, again, this is never 100% accurate, but it gets us to a place where we feel comfortable that to a large part, the income estimation is a reasonable, fair assumption of what the household number could be. And a lot of this is possible only because of technology, because ultimately you have to figure out a way of standardizing everything from all the different inputs, automatically flagging it, and then kind of outputting the income to kind of ensure that it is in the right ballpark. And all of that is driven automatically from a platform standpoint that we manage. And that kind of gives us the flexibility to estimate income in a more accurate manner. The other piece that we are exploring, and as this, there are other data sources that we can start looking into, and which again is technology driven. Like we are trying pilots with SatSure, where we are trying to say, okay, based on satellite coverage of the farmland, can I start estimating what could be the income that is coming over the last 3 years of data and how stable that cash flow is? Because one is assessing point in time income, one is stability of cash flows and how stable that income assessment could be, which also is something that we are trying to do through some of these other data points and other sources that may come in here.
I think a very interesting thing on the surrogate. So, if you cannot get the exact data from your field people, then possibly evaluating options like SetSure, which gives you some inputs on the farmland and the possible cash flows from that land in last couple of years. So that may be an interesting option. And I'm sure there would be many more such options that will come up as we move forward. And, our requirement to do household income will become that much more compelling. But right now, I think the challenge, and I almost feel like I'm too tempted to change my head from moderator to someone who will start speaking. But the quality of data that is captured also is a bit of a challenge. So it is like garbage in, garbage out. So if you are not able to maintain the quality of all that you are capturing, whether house is pakka or kacha, whether they have 2 cows or 4 cows, or they have a two-wheeler or a four-wheeler, if you don't capture it right, then whatever outcome you will get also is going to be a big question mark. But the good news is that I'm sure we are making a lot of progress, and a lot of surrogates are now either available or going to be available as we move forward. So with that, I'll move to the next question. Sorry.
Yeah, and I was just saying, and the piece that we were talking about to surrogates and to what Mr. Patnaik also mentioned is how verifiable are these surrogates? Something like if you have a two-wheeler versus two-wheeler, it's much more easily verifiable, as again saying I got this much money from selling land. So trying to find surrogates which are more easily verifiable in this segment will help us be more comfortable and kind of have a better sense of what the income is.
Yeah, correct. So my next question will be to Krishna, and I'll just take this surrogate thing a little forward, and I want to understand and pick your brain on, what are the possible proxies and measures that we can look at when no documents are available to either assess the income or the repayment capacity. Just tell us something from your own experience.
Okay, so I represent. Thank you, Purvi, for the question and for the invitation. And I represent here Kasafi, the state association for microfinance in Kerala. I also had a startup called Sa-Dhan, where we have like recently soft launched a marketplace for microfinance, connecting lenders and the microfinance customers. So I'll share some of the learnings that we have, particularly regarding the surrogate. So I completely concur with what Mr. Nagraj mentioned, that we need to have we need to pick surrogates which are verifiable. Otherwise, our field officer or whoever does the job are very smart to tamper the system. So unless it is verifiable, it is better not to waste much time in collecting the data, because it is going to be just an added work for the field, and that field is going to take the system for a ride. So when we are coming to the verifiable surrogates which are easily available, one is the vehicle proof of ownership of vehicle. Other is the electricity consumption. Then the third one is LPG consumption. Nowadays, like most of the households would be having the LPG cylinder connection. So LPG consumption could be verified, like how many days, what's the periodicity of they ordering a new gas cylinder. So things like that which are verifiable. And if you are going for amenities, I would really recommend to have some check and balances. For example, like we take photo of the household and that gets tagged, geotagged, and if the photo of the amenity has to be taken, that has to be also tagged and like immediately checked whether it is from the same vicinity. Otherwise, like again, the people will take the system for a ride because inside the house, empty photo anyone could take from some other houses also. And regarding the amenities, one thing that we have done is like instead of like asking to feed all the amenities, which is going to be time consuming, etc., we have like ordered on a hierarchical scale, and whichever is the amenity which is on the top of that list, they need to just take a snapshot. So it's just a single photo. But we kind of assume that okay, if going this is the normal hierarchy of the amenities mentioned, and if somebody is having that particular level of amenity, then some of the bottom things are also available in that particular household. So these kind of things are what we are doing, slightly different, but otherwise, what other the sir has mentioned, Nagraj has mentioned, everyone was talking about the surrogates, and my only thing is verifiable surrogates need to be there. Otherwise, business team would take the system for a ride, and and I've also observed that even when there are like a separate credit team for doing this, sometimes what happens is that like there is a single credit person in that branch who is living with 5 to 10 of the business people. So after doing the credit underwriting, all of them are going out for lunch to the movies so there is a like deep peer pressure in that loan employee to sometimes not to do that assessment correctly, because whatever he does might be affecting the business prospects of all other people. So if at all possible, can we remove that person credit underwriting? Of course, it is better to have a separate team, that's for sure. One loophole in our entire system is the business is itself doing the credit underwriting in many places, but it's definitely better to have a separate team. But can we remove them physically from the branch also, so that the pressure from that business people might not be there on this single person? So these are my thoughts for what you have mentioned. Thank you.
Thank you, Krishna. That was helpful. So, given the challenge, I think about the income assessment or how credit team can work independently or how verifiable your surrogates are, I think in the entire process, there is a huge role that our credit risk compliance teams have to play. And so my next round of question will be around how do you manage the risk? And my first question is for Anpurna. Mr. Patnaik, if you want to answer this, what are the checks and balances you think should be put in place so that we can identify risk a little early? So basically the checks and balances which are required for early identification of risk in the field.
I think I'll leave it to TP to answer. He's the right person to just to give you a perspective for TP answer is that we have a predictable model in place which could identify a riskier client than, based on our previous experience and the data that we have. So on that note, I think I'll leave it to TP to answer.
Thank you. Hello, everyone. My name is Anup TP. I'm heading the risk department for Annapurna. So, yeah, as our earlier members of the panel discussed, we have come to a tricky stage wherein the calculation of income is becoming very difficult. And in fact, a lot of manipulations are going on in assessing the income as well. Like the way in which Sa-Dhan has reported the numbers, like one MFI is reporting The same customer's income as 12,000 and someone else is reporting it as 15,000 or 24,000 for that matter. Well, in my institution, I am the one who's always questioned when a customer get rejected based on these irregularities, income reportings and everything. So as a company, what we have done is we have come up with a ML-based model, machine learning model, which is typically done through what you call as XGBoost model, which is a sub part of machine learning model. Basically, to put a perspective to it, what we basically do is we understand that there is a difference in the income calculation. So what variable which we can rely on? So we are relying on the historic trend of the customer. So therein the focus is on. It's quite possible that the income may not have increased much. Let's say before RBI, if their income is, let's say, 10,000 rupees, most probably, adjusting the inflation and everything, maybe the income increase may be limited to 7 to 8% on a yearly basis. That won't have much of an impact. What is impacting here is what was the EMI which she or he was paying, let's say 2 years before, 1 year before, and what is the current EMI they are paying. So that is where we are catching up the customers. That is where the model is really based on. So let's say someone who's paying 3,000 or 4,000 rupees EMI, all of a sudden the EMI outflow, the income outflow towards the loans has become as 7,000 or 8,000 for that matter. That is where the real hit would come in. So the model works in majorly on credit bureau data plus our underwriters data. So nearly 25 variables go into the system, and based on these 25 variables, we come up with a risk scoring for customers. And based on those road systems, we are assessing them whether they can repay that particular EMI or not. That is one part. Secondly, it has come to a stage where a continuous assessment of income is needed, or continuous assessment of customer behavior is needed. We as a company, we are in larger stage. We are going for a portfolio review on a monthly basis. Each and every customer's income outflow, EMI, and the outstanding loan is considered. Thereafter, we reclassify our portfolio, whether it's high risk, low risk, and medium risk. Accordingly, we are taking a decision on whether to give a second cycle loan, or whether to withdraw from an area of operation. So we have an index called saturation index. So something which I haven't seen much in the industry per se. So we are benchmarking each and every pin code and villages of ours as highly saturated, medium, or low saturation. So for expansion, for a branch, customer acquisition, for a branch expansion, these indicators are used to effectively to focus our attention to areas which are not saturated, and to withdraw from areas wherein the credit bureau rejection is higher. So these are some of the methodologies we have put in place. And my request again at this point of time to Sa-Dhan would be, it will be difficult for smaller microfinance institutions to buy these information or subscribe to these premium services. Sa-Dhan and MFin and Sa-Dhan, both being SIOs, they are currently providing us with pin code data for different aspects, which is credit bureau the PAR increases, number of customers. I would say a proxy can be created for saturation index as well. So this can help the entities to identify which area to operate or which area to withdraw their presence. These are some of the techniques we are currently using for risk mitigation.
Sure, thank you for sharing. In fact, that's very interesting, and I'm sure Sa-Dhan can help with some more data. Of course, Sa-Dhan is publishing a lot of data, but how to put that in the system and how that data can be used for making some credit decision. Maybe if we can come up with some commonly acceptable data formats and some templates, that would be useful. My next question, since there is a lot of technology and machine learning that I've been hearing, Mr. Nagaraj, would you want to tell us something about how you are using technology to pick up those early warning signals on indebtedness or some stress in some portfolio geography? So what is your methodology there?
Sure. So I think there are two things. I think one is the pre-disbursal stage, which sort of what Anup also mentioned, is we have a machine learning model which looks at bureau data, their trends on bureau, how they've been performing. We look at industry level trends. So we have a model which kind of looks at all of this, plus the cash flow and the asset amenity data together, which together kind of build a model which kind of talks about the probability of default of this borrower if given a loan and the appropriate level of leverage that this borrower can kind of take on. That gives us at least an initial assessment in terms of how much, whether to approve or decline the borrower, and how much to kind of provide the loan for, because that depends a lot on the leverage also that the borrower has. And not only at a borrower level, but also at a household level, because that's definitely something that is required to understand, because that ultimately the way we are estimating it right now, especially in MFI space, is household level income, but to that, what is the kind of household level obligations that the household has that we have to do it. But once the dispersal is done, I think there are 2 or 3 other things that we see. And one aspect here is, given the model we have where we work with different partners on the ground, operational risk in terms of figuring out locally what is happening, which partners, which branches, which states have issues. So that is being done through pretty much extensive data collection, both from the industry side as well as from each of the partners. And being able to kind of look at that together to say, is there an early warning signal that we can pick up in terms of trends happening in that district? Is there something that we can pick up based on, I don't know, huge attrition that has happened in a particular branch, which can lead to higher collections, requiring us to kind of then put in additional effort in terms of what we do from a collection standpoint. So a bunch of that data analysis goes through, which kind of give us an indication if there is something early happening. The other piece we also do, and is more regular bureau true-ups. So even for all the disbursed loans, we get scrubs, which kind of tell us how the borrower is performing on other loans basis, which we can create early warning signals for our collections teams, which tell us that, yeah, this borrower is going delinquent on some other trade line. Let us be careful. Maybe start focusing more on collections on this set of borrowers who have been, they may go into trouble later with us also. The other thing that we look at is also the livelihood streams that they are in, which again, things like a SAT will help us in terms of understanding if there is some macro events that are happening which will impact future cash flows, basis which also we kind of then come back and say, should that area be focused more on from a collection standpoint? What should we do? What kind of action should be taken there?
Great. So my next question would be to Krishna. And I just want to know that, we are talking about early warning signals and all of that, the role of a credit team and the role of a risk team here when we are talking about early warning signals. As a representative of a state association, what are your learnings from the past crises in your state? Just because, the income assessment was not proper, and how do we learn from our past mistakes, and how some of those crises can be, or some of these issues can be mitigated. So from a state association point of view, would like to hear you.
Okay. So I believe the learning from as an industry, we have got so many crises, and the lessons are there at plenty. Only issue is that we do not imbibe those and implement the learnings. So having said that, say here, if you look at Kerala, there were suicides happening in a particular district in Kerala, where we had to then engage with the administration, etc., to make them understand how microfinance works and all. And here, so this is not actually an early warning signal kind of thing. It's an unfortunate, multiple series of few unfortunate events that have happened. And when we did analysis of what happened in the field, what came out is that the income assessment and indebtedness assessment, we were focusing on the income assessment in all our discussion, but we have also seen that indebtedness is also not assessed correctly by many organizations. Some organizations might include say gold loan into the assessment. Some might exclude gold loan from the assessment. Some might not consider the full indebtedness of the spouse. So at that level, that also we have observed, indebtedness is also not done properly. But majorly, it is that we have gone ahead with the standard template of microfinance for a long time, where we say that, okay, first cycle, my organization is going to give 30,000 or 40,000 of loan. So irrespective of how much they could afford, if within our organization rule, they are just like we are making them eligible and we are pushing that loan to that particular customer. So when I say that how it is done, as you could see from Sa-Dhan had shown that is, of course, is just a sample data of one customer that was shown, but that is the industry level trend also. Immediately after the income level was raised by RBI for classification of microfinance, almost like 75% of the country's population suddenly got 3 lakh kind of income. So that's where the root of the problem lies, where we are pushing loans to the customers without properly assessing the income and the indebtedness. And I do not think that is a problem at the field level, because that starts, I believe, at an organization level. We all need to rethink, because loopholes once identified should be plugged by the organization. We know these things are getting repeated, but why we are not taking action and ensuring that we are plugging those loopholes so that nobody can take the system for a ride. So that kind of action we are not seeing actually happening. So from our industry, like from Kerala industry level, what we have observed is the DPDs are going high month on month. If you look at the previous 3 months, DPDs are getting higher, and at the same time there is a huge pressure to push the loans. But luckily now we are talking to a few very large entities operating in the state who have said that like they are going to go a bit slow. It's reflected in the credit bureau data also, the disbursements happening. So yes, that responsibilities some of the larger players are happening, but are doing that. But we can see many people who are not coming under Sa-Dhan or MFIN, but still engaged in microfinance activities. Nidhi companies are there, small other type of lenders are there who are pushing the loans without, of course, they do not even have access to credit bureau data. So without any checks and balances, these disbursements are happening to the same customers. So this is from the industry point of, like Kerala industry point of view.
Krishna, I really like the point that you made on, it is not just a field level problem. I think that's a very important statement, and everybody has to understand while aggression is good, but also we should not end up, spoiling the quality of our own portfolio. So I think a balanced view or balanced action is something that one must have. So with that, I will go for the last question of this session, and that is mostly around the role of a risk team. And because we are now not a very small 30,000-40,000 crore industry, we are, as per September data, we were already close to 4 lakh crore industry, and I'm sure with the latest data coming out, we would surpass 4 lakh crore number. The way we are growing and the way we are becoming mainstream industry, the kind of players that are entering the mainstream NBFCs, and a lot of excitement in the sector. With that, I just want to know something from all three of you on how do you see the role that risk team would play in identifying and mitigating the credit risk and customer distress in the days to come. Maybe I'll start from Avanti this time.
Sure. Yes, I think to your point, I think the risk team plays a very critical role, and as the scale increases, more and more relevant. The way I kind of see it, I think the core of the risk team is one. There is definitely one piece which is saying, how do you ensure that you are giving credit to the right amount of credit to the right borrower, right? I think that's very important. So the leverage making sure that they're very focused on that and making sure that we have good, accurate, as far as possible, accurate data in terms of how we are assessing the borrower is key, right? And what can we do as a risk team to explore all the different avenues that is there in terms of other sources of data, other avenues, other metrics that we can start looking at, which gives us this information will be critical. Our role is, the way I see the role of the risk team is just not about we will run a bunch of rules or create algorithms. It's also about going beyond that and saying what else can we do, which can give us the ability to start assessing the borrower well and ensure that we are not over leveraging the borrower, because ultimately over leveraging the borrower impacts the entire industry. The other piece of it is the constant monitoring, right? How do we ensure that the right early warning signals are taken into account? What kind of data can we leverage? And there is a lot of data that is coming out there now. How do we ensure that the risk team is able to kind of go back, see which data is noise versus signals, and then appropriately use the data to be able to predict as to what is going to happen and how do we take early actions with, because issues will happen. This is a lending business, as the core of the business, we will see issues happening, but can we catch it soon enough so that we are able to kind of take actions quickly, as against waiting for things to blow up. But I think that is probably what I would say. I think constant monitoring, continuous monitoring, and the right assessment of the borrower is probably what we should be looking at.
Sure. Something coming from Anpurna on risk team. Mr. Patnaik, you want to say something? Yeah, TP, please go.
Yeah. So again, I completely agree with what Nagaraj has mentioned. So it's about leveraging the right data at the right point of time. And more than that, I would say, it's a short-sightedness which is creating the problem. So the near-time business pressure is what is creating the problem. We have run an assessment on a time series assessment on the delinquency patterns. It always been spiking that the quarter end months and majorly the Q4 numbers. Their slippage ratios are the best, highest among all the numbers. I mean, even just after COVID, whatever numbers you take, the Q4 NPA slippages are at least 50 to 70 pips higher than the normal time period. So what we need to understand, it's not the short time goal we have to have. So we have a 22 or 23 crores of customers, potential customers to cater to. We have just reached 7 crores. Let us focus on the larger agenda. Let's not focus on the short-term business goals. So that is what the risk management is about, and that is what the risk team's primary objective should be in any of the organization.
I think more than that, it is the management to take the call that at what speed you want to push your growth and in which geography you want to push the growth. The risk team can only tell you where the risk is. It's the management who can either overlook at them and still run the business. And I think Sa-Dhan has to play a bigger role here as an association to to bring in a standardization in terms of how do the income assessment is done correctly by all the organizations. There cannot be a 15, 25 and 35,000 assessment of a client. Either it is 15 or 35, it should be only one. And if we can build in a consciousness among the people, to follow a methodology which is acceptable to all, that is one. To do the income assessment to the core. And second, also on the growth, because these all income assessment, everything goes for a toss, as Krishna was mentioning. When you push the ball downstream, then they all goes for a toss and everything risk and all we know. And we have seen it in our own organization. I will not be very proud of telling you that, in some cases we have actually overlooked our esteem, and then we got into the problem, and now we are not, because after doing it once, twice, we realize that whatever our esteem tells us has a merit in it, and so we trying to control our temptation around that. So that's something which the industry leader also need to look at.
Sir, you are a veteran, and I also would like to ask you a question. Like, for example, the data that Shamashri just shared, that you evaluated some customer at 15,000 and you gave a loan of X amount, and somebody coming next to you will evaluate that customer at 35 and give much larger loan. Now, customers' actual income, we have no idea what exactly is the right income, and if the money for the larger loan gets stuck, even if you have done your credit right, your money will also get stuck. So while we can have a separate credit team, we can look at all the algorithms and all sorts of data and information. Unfortunately, we have no control over what next person is going to be, or people. And I wouldn't say person, I would say bunch of people. What they are going to do with that customer and how they are going to do, how they are going to treat that customer, is something that is a big challenge. Like, for example, in housing finance, you go to any company, they will look at your documents, and it will be more range bound. So somebody may want to give you 80% of the value, somebody may want